The US dollar remains extremely vulnerable after a significant rate cut from the FOMC of 50 basis points. Is it going to continue selling? Guys, Ken Chigbo back with another E8's market fundamental update. Let's jump straight into this. So guys, as I say, the highlight of the week without a shadow of doubt was the FOMC starting their rate cutting cycle with a significant one of 50 basis points, which was obviously very well received for stock markets in the United States. We saw a rally with US stocks and global stocks in general, dollar coming under pressure because obviously that's a sizable rate cut. And remember, when we're cutting rates, naturally we get outflows from the respective economy. Remember, markets are seeking, the big boys are seeking yields. And if we're getting rates being significantly cut, markets are then seeking yields, higher interest rates, higher yields elsewhere. And for me personally, on a level of just giving my opinion, I believe that is a significant cut for a very potential reason. Perhaps we're seeing, the FOMC is seeing something that the markets are not quite seeing yet. Maybe we are seeing potential risks to the global economy. I believe that we're seeing slowdowns in the likes of China. We're seeing slowdowns in the Eurozone, which are big economies. And some of the things that we're seeing, some of these alarm bells, I believe are a little bit reminiscent of what we saw ahead of the 2008-2009 crisis. And bear in mind, when the FOMC cut rates by 50 basis points last week, it was on September 18th, right? September 18th was the very date they did that sizable cut in 2007 ahead of the crisis. So just some food for thought there. Anyway, this week, if you look at the latest one, dollar closing in the red, we've been very much to the downside, okay? Remember, we've gone over this within the past weeks where we were in this trend to the north because those three key pillars that are supporting the dollar, we don't need to go over them again. We've been going over it for the past few weeks. Those three key pillars started to erode. We had a dovish FOMC, data softening, inflation softening, and obviously trending to the downside. And now we just look so vulnerable after paring back the ascent of 2024. We've pared back those gains completely. We're testing a very, very key support here at that sort of 150-60 area. Can you see it's tapping, knocking on the door. The bears are knocking, potentially to open for a wave of downside momentum. Okay, and you can see structure's been very clean. We've been printing lower highs, lower lows, broke out this recent wedge here and this most recent lower high. And obviously, as you can see, we're tapping on that support and it just looks like we're forming another bearish pennant subject to that support giving way. You can see that, guys, it's significant. And my eyes are now on the lows of 2023. Okay, as you can see here, these are the lows of 2023 and perhaps coming down there ahead of potentially, maybe once we get down here, the bulls reestablish some momentum when, that perhaps that narrative of recession kicks into gear and then we get those safe haven flows into the dollar. Anyway, this week, we're going to be keeping an eye on manufacturing and services PMIs to see whether we get in this worries about the slowdown in the US economy. But the highlight will be two things. Fed's Powell speaking. Okay, let's see if we get some more color from Powell as to the future of rate cuts. They've left the door open to multiple cuts still until the end of the year. And then we've got the Fed's preferred measure of inflation expected to remain at 0.2%. Obviously, if that calls, dollar will be in trouble and set for another wave of downside momentum. So definitely another key week once again for the US dollar. Expect plenty of more volatility there. Next up, we have volatility for the euro because we've got PMIs, manufacturing and services PMIs. And I've stressed to you guys before in previous videos, the importance of these, right? They make up a decent part of, giving us a good gauge in terms of economic performance for the Eurozone as a whole. They're a decent manufacturer. Remember, we've got a lot of cars being manufactured in the Eurozone. They are heavy in terms of services as well as a Eurozone as a whole in terms of the economy. And obviously, I just spoke about in that previous, for the dollar section, I spoke about the slowdown in the Eurozone. So if we see, obviously we saw the ECB cutting rates, there's more rate cuts looming. We're getting a slowdown. Clearly we see in certain data points. If these numbers disappoint, that will reignite some further worries about the Eurozone in terms of economic slowdown. And we could really see the euro coming under some pressure versus some of its peers. Now, if we take a look, obviously versus the dollar, is taking advantage of the dollar weakness, right? We've had, if you look here on the daily, something that I was watching, we had a nice flag here. Can you see a big breakout there to the upside? And we've just been extending to the north since that nice little clean breakout there, making sense technically, going hand in hand with the fundamentals as well, with the FOMC cutting rates. And we had a bit of an inverse head and shoulders here, the left shoulder, the head, the right shoulder, breaking out, retesting, and subject to some further potential buying momentum. I think really, if we can clear down this sort of 160, 170 towards into 112, about a 50 pip range, okay? These highs there, you can see there's clearly supply there. If we could break that down, if you look further left, we're going to run towards 112.50. For me, if I'm being really sort of honest on a analytical level, macro and technically, I don't see a lot of opportunity for euro to break past this, okay? Especially if the narrative picks up where we're getting potential recession fears and those flows kick back into the dollar. That could be the ultimate near-term top for the for euro dollar, in my opinion, but we'll see, okay? But otherwise, obviously, to carry that through, to go and challenge this sort of 112.50 area, we really need to see this data coming out in line, if not better than expectations, to calm down concerns about a Eurozone slowdown. We've got some more central bank action, this time in Australia, with the RBA, the Reserve Bank of Australia rate decision, where they're expected to leave rates unchanged at 4.35%. Now, we know with the RBA, we have a bit of a divergence with them. Where other central banks are talking about rate cuts and actually cutting rates, these guys have been warning the markets that we could hike rates if need be, because inflation remains sticky, it remains well away from our inflation target, and we could hike rates in order to bring down inflation. So, if you look here, interestingly, in the same week, obviously on Tuesday, ahead of the after the RBA, we've got inflation data, and I'm sure the RBA have that data to hand ahead of the official release, and it's expected to cool down from 3.5% to 2.8%. Obviously, in these previous readings, remains very elevated, which is one of the reasons why the RBA have been hawkish. So, look, I expect them to maintain their current stance, ready to potentially hike if need be. Warning about inflation needs to come down quite respectably towards their 2% target. Otherwise, they will keep the door open to the possibility of a rate hike. That stance should still be quite bullish for AUD unless they say, look, we see inflation coming down now, which would obviously weigh in on the dollar. But the way we're looking at the moment, trending to the upside there with AUD specifically versus the dollar. On a daily, again, look at that trend. It's so bullish. Lower highs, higher highs and higher lows. The structure very much to the north there. On the 4 hour, we've just got a bit of consolidation going on, forming a potential. Maybe we get a nice little bull flag here. And as I said, with the structure, you can see that clearly to the north there, respecting this trend, this ascending trend line, okay, pushing to the upside. And maybe this big bull flag, we get that breakout to the upside if the RBA obviously remain hawkish, with policy. Not talking about any rate cuts, still leaving the door open to the possibility of a rate hike. As I say, it's very much dependent on the CPI as well. If that doesn't cool down as fast as what markets are expecting at 2.8%, AUD is going to push to the upside. Obviously, as a base case, we're always looking at AUD versus dollar, but you can look at GP AUD, you can look at Euro Aussie, you can look at Aussie CAD, Aussie NZD, so on and so forth. But it's just us looking at Aussie versus dollar. And at the moment, we're still taking advantage of that dollar weakness. But one for your watch list for sure. Also expect some volatility from the Swiss franc, where we do have the SNB rate decision. They're expected to cut rates by 25 basis points. Interest rates at the moment are 1.25%. There's an outside chance that they could cut by more, by 50 basis points, but that may be unlikely because although inflation's coming down, there's risks of higher in services inflation, which may obviously reflect on the overall inflation picture in Switzerland. So I think they will just cut as expected by 25 basis points, which if they do, CHF most likely will strengthen, especially if they remain cautious on more rate cuts dependent on inflation. If we look as a base case, dollar Swiss obviously very much structured to the downside, taking advantage of that, that weaker dollar. But we've come to a massive area of demand here, as you can see, around sort of 84.30, sort of protecting 84.00. Okay, where we've probably got a room for another push to the upside, okay, before further downside. Okay, you can see structures nicely to the south. Sort of lower highs, lower lows, you can see that. But maybe we come and respect this upper acting trend line as part of this bearish flag, and perhaps we can get rejections there and resume this trend to the downside. And really, when you look left, we're going to have to go on a higher time frame here. The next major support, couple of areas really. We've got, let me just mark this up here. We've got this big wick here around sort of 83.00. That's the next major area that we'll be looking at. But we could very well break through that depending on the momentum to the south. So yeah, depending on if they just cut by 25 basis points, then expect some CHF strength. And CHF is gaining some ground at the moment as well, just on the potential risks, of global slowdown, the potential safe haven flows as markets fear recessions globally, so on and so forth. So some safe haven flows, especially with the geopolitical concerns as well in the Middle East. So plenty of volatility, more talking points. Stay lit, stay blessed, and I'll catch you on the next video.